Well, thanks to the organizers for putting me on the program. This is joint work with Imo Schott, who's in Montreal. And yeah, that's very exciting for us. It's the first time to present this paper, so it's part of a bigger project, but this set of results is the first time we present them. So everything now is still work in progress, so all your comments are highly appreciated. And what are we doing here? So we think about business cycles. So they are, for instance, US GDP fluctuates over time at annual standard deviation of 1%. And it's interesting to understand why. So economists write down models of business cycles to understand why does GDP fluctuate so much. Because, of course, then we can ask question is, do we like this fluctuation? Do we want to stabilize output? If yes, how? And then these models you can put broadly in two categories. So one is a set of models where you have big shocks, which create these big fluctuations. That's one way to go. And the other idea is, which is around for a while, is, of course, it could also be that there are small shocks, which somehow endogenously by the economic system get amplified. And this is the box where this paper belongs. And more particularly, this amplification mechanism is supposed to be the financial market. There's this old idea that something goes bad in the economy, and then this bad shock is amplified by credit markets. And this is this project is about this. And of course, it's not the first paper about this. They're very classic, very influential, very widely read papers about this topic. For instance, Kiyotaki-Moore, Bernanke-Gertler. These are different approaches where there's something happening of the business cycle, and this worsens credit market conditions, and this in turn amplifies the real effect. And the problem is with, for instance, these approaches that once you put a little bit of, once you try to put some quantitative discipline on these models, then in a quantitative exercise, usually these amplification mechanisms don't perform very well. So you don't get really any bang out of these models. And yeah, this is when we depart from literature, and we observe that in macro in general, in particular in these papers, but more general in macro, usually when people write down models of debt, all debt is short-term debt. This means in these models, all debt issued in period T is supposed to be fully paid back in period T plus 1. And this is, of course, per se, this assumption made for tractability is per se not an attractive assumption. So we know that the average maturity of US bank loans to firms is between 3 and 4 years. Corporate bonds have even much longer maturities. And yeah, 3/4 of US corporate debt will not mature within the next year. So all these things are long-term debt contracts. And then the question is, do we miss something important if we don't include this in the model? Or is this a fine, innocuous assumption to abstract from this nature of long-term debt? And in particular, we find, so once we put this long-term debt into a model, and this is a standard model of firm financing investment. Once we put it there, we find that this introduces a new novel mechanism of financial amplification or real shocks. And in particular, there will be, in this model, there's a negative feedback, there's an adverse feedback loop. So whenever investment goes down, spreads will go up, credit spreads will go up. This will increase the cost of capital of firms, which again makes firms want to reduce investment and so forth. So there's a new amplification mechanism which arises in this model with long-term debt. And we find that in our quantitative exercise, this amplification is sizable. Yes?
You're doing a good job of summarizing what you're doing, but I still don't understand why it's happening. Maybe I'm supposed to wait.
Yes.
I mean, if you have a model where people have a choice between long-term and short-term debt,
yes,
and long-term debt presents a hassle,
yes,
then I just have all short-term debt.
Exactly, and the firms will not do that, and that's interesting. And this is one of the interesting results, yes.
But I can't imagine why. Given what you've said so far, I can't understand why they don't have all these short-term.
But at this point, it's fine. It's okay. So in this model here, in this model, the output response is 150% of a frictionless setup. Okay, this is and we call this sizable because that's about in a sticky price setup. So a very different model, of course. This is what other people have found, and they call this sizable. That's why we call our effect also sizable. Okay, and that's now we get a bit at the economic intuition. No? What's going on here? So the key feature which we introduced by having a long-term debt model is that now firms take decisions in the presence of existing debt which has been previously issued in the past. With short-term debt, it never happens. So normally, with short-term debt, all debt is issued today and fully paid back before the firm takes again new decisions. And that's now different. That's the key difference. And yeah, we find that our firms maximize shareholder value. That's a standard assumption. It means firms do not care about the value of debt per se. They care about the value of debt to the extent that it inflects shareholder value. Now, shareholders, they like to have a high value of debt, so to a high bond price, because this means if they sell a given amount of bonds, they get a lot of revenue from the bond market. And this means for a given desired stock of capital, they have to inject less equity. So that's why these firms, they care a lot about the value of newly issued debt, okay, through the bond market. The problem is that these firms, they don't care about the effect of their actions on the value of existing debt issued in the past. So if this firm, for instance, influences this value because the firm chooses leverage, high leverage will mean a high default risk. If this firm chooses high leverage, it takes into account that this lowers the bond revenue raised on the market when it issues new debt. But the firm disregards the fact that by raising default risk, it also lowers the value of existing debt issued in the past. This is something which is true in this model. And it means that in this model, whenever the ratio of previously issued debt to total debt is high, then this firm disregards a large fraction of the total expected default costs, and therefore then chooses higher leverage and higher default risk. Okay? This is something which is true in the model, and it turns out this has important effects for the business cycle. Because now if you consider any negative shock which induces firms to reduce investment by some amount, now this means this firm will borrow less, so it will issue less new debt, so the total amount of debt goes down. The amount of existing debt is still high because this comes from good times in the past. This means this ratio of existing debt to total debt increases. This means the firm now internalizes a smaller fraction of total expected default costs, so chooses now higher leverage and accepts the high default risk. This in turn means creditors rationally pay a lower price for the debt, so they charge a higher credit spread. This raises the firm's cost of capital, so the firm invests even less. And now we're back in step one, right? So now again, this means the firm reduces investment even more, total debt grows even further, this ratio increases even more. This is this feedback loop between low investment and high credit spreads, which is present in this model once you put in long-term debt. And yeah, so we studied this.
But the question was,
yes,
since you know this can come up, why did you issue all of this?
In the beginning.
Buy all this long-term debt, sell all this long-term debt to start with, and it must be because you like having more default risk in a bad time.
No, it's true.
So
if it's okay for you, I would like to answer this. So I have a two-period model where this question does not show up because their long-term debt issued in the past is an exogenous variable, and then later we endogenize this, and then I will explain more why firms end up with having lots of long-term debt. Okay. And yeah, a brief look at the literature. So of course, we relate to this number of contributions, and there the big difference is that, for instance, even so newer contributions like Brunner-Meyer-Sannikov, they get lots of amplification, but in rare events when they get taken far away from the steady state. So in this model, only very rarely these differential credit conditions matter for amplification. In our model, every shock is amplified by this mechanism. Yeah, this is a related approach. This is a different paper where also there's also long-term contracting, which introduces amplification. But the difference is that in this model, the commitment problem gets more severe in boom, and this causes amplification. Our case, it's the other way around. But I don't want to confuse you more with this. So, and maybe what's interesting also here, there's a big literature which relates corporate credit spreads to the business cycle. And this is something, of course, in many models, we don't have a big role for these things. In our model, this is the key amplification mechanism. So we relate very closely to these findings. But yeah, let's go to the model. So what's going on here? So we have this two-period model where we kind of get a lot of intuition for a dynamic setup. So these are two periods. There's a firm. We look at a firm which is owned by risk-neutral shareholders. And this firm, in period 2, produces something, produces output. It has inputs capital and labor. And there's diminishing returns to scale. And there's aggregate productivity. This production is set in period 1. So these firms, output is produced in period 2, and then earnings in period 2 are determined by output. Then they have to pay wages, there's depreciation, and there's an earnings shock. So this epsilon here, in period 1, when the firm decide about capital and labor, they know productivity is Z, but they still don't know the value of epsilon. Epsilon will be high or low. This is realized into period 2. This is the only source of uncertainty which the firm faces here. And yeah, this is what the firm does. Now, this capital, so the firm only finances capital 1 period in advance. So there's no working capital idea. So the firm only uses financing to finance capital. And it can do so in 2 ways. So one way is debt. So we allow the firm to use debt. There's a debt. Yeah.
Like a shock to total productivity and to the marginal productivity of capital. Shock to both, no?
Yes. So for all what I say, the 2-period model, it could also be, we could also have an epsilon here and nothing there. So nothing which I say here depends on that. So we just have it here because later in the dynamic analysis we need really big shocks to have for low leverage, like in the data, to still have some default risk. And that's why we need, we don't want to assume that there's negative output, but still we need negative earnings. And that's why the shock is here and not in output.
Is the shock to the interest rate or the return? Is the stuff how you should interpret it?
I mean, you can think about this firm. I mean, one example could, I don't know. So it could be the firm produces a certain good with certain machines, for instance, and then it turns out that nobody wants to buy these goods, and so also the machines lose value, and then you have a capital loss here. This could be one idea. Or you lose a lawsuit or something.
It's like a shock to the depreciation rate.
You can think about this like that. Yeah, it's the same thing. Yeah, exactly. Yeah, exactly. Yeah, and this capital, you find it in one of 2 ways, or in 2 ways. So one is debt. So this firm can sell a bond, and this bond is a promise to pay 1 unit of the numerator good together with the coupon payment C at the end of period 2. You can sell these contracts, these bonds, and if you sell a number delta of these bonds, and there's a market price for these things, then you raise the amount P times delta on the bond market in period 1, and you can use these funds to buy capital. That's one thing which you can do. And now we want to talk about long-term debt already in this 2-period setup, and that's a bit, of course, it's hard because this firm only issues debt once here. So we assume at the beginning of time there's some exogenous amount B of these bonds already outstanding. And you can think about this as long-term debt has been issued in the past, but the key difference to these 1-period bonds sold now is that this is exogenous. The firm does not choose this, it's already set in the past. It's just a parameter here. And apart from that, this is identical to the 1-period bonds which the firm sells in period 1. And this means then the total stock of debt in period 2 consists of this legacy debt, or this long-term debt issued in the past, if you want, and the new debt. This together then makes the total stock of debt B tilde in period 2. This is debt, and now how is capital determined? So there might be some initial amount of assets in place, Q, then you sell these new bonds and you get delta times P, and shareholders can also inject equity into the firm. So the firm can issue new shares, and this is completely frictionless. So there's no equity issuance cost, the equity margin is completely frictionless. And these are the 2 ways to raise the level of capital. And so why do firms, what's the trade-off here between debt and equity? What's the capital structure theory? So firm earnings in period 2, they're taxed at a rate tau. And this means shareholder net worth Q tilde, this is the one which shareholders care about at the end of period 2, consists, this is the whole assets in place minus the debt payment, then plus these earnings, but these earnings are taxed at rate tau. And the nice thing about debt is that you can deduct these coupon payments before you get taxed from your taxable income. And this means debt is a way to channel earnings to investors without facing this corporate income tax. This is the only reason why firms now model like debt in the first place. The downside of debt is that it's not always paid back. So there's limited liability. So in principle, shareholders, if they want to, they can always just walk away and leave the firm as it is. And then creditors, all they can do is just take what's left in the firm. And a fraction Xi is lost in this case. So these assets of the firm, they're worth less to creditors than to shareholders. And that's why they don't, there's a default cost here. And that's basically the whole setup. So we start this model. So this firm has some assets in place, some debt in place, and they observe some aggregate productivity level. And given this, the firm chooses how much to produce, so capital and labor, and how to finance this through equity and debt. These are the decisions. And then period 2, epsilon is realized, and this then tells the firm how big are the earnings, and then the firm decides whether to default or not. That's always going on here. And the nice thing with this two-period model, we can solve this very easily by backward induction. So we just start in the very end of this problem. So epsilon is realized, and now this firm compares what to do, default or not to default. And whenever epsilon is very low, now ex post net worth of the firm is very low, and then full repayment would imply negative net worth. And then shareholders ex post can always do better, but just to default. And so there's a threshold value epsilon bar. Whenever epsilon is lower than epsilon bar, then ex post shareholders prefer to default. Whenever epsilon is higher than epsilon bar, then the firm will continue and there will be full repayment. So now in period 1, this firm anticipates that this can happen. So the firm maximizes the shareholder value. The firm knows that, so there's a cost of injecting equity because it's the cash flow from shareholders to the firm. And then, but the benefit is that in the future, whenever epsilon is higher than epsilon bar, then in this case, the shareholders get the net worth of the firm. And this constraint tells us when default will happen ex post. And output is this production function. As I said, capital consists of assets in place plus newly amount raised in the bond market plus equity. The total stock of debt consists of this legacy debt plus the amount of newly issued bonds. And let me just zoom in on the firm objective here, because that's something interesting to realize. So this firm maximizes the shareholder value. It doesn't care about the value of debt per se. But if we used, for instance, this capital equation to substitute out equity here, equity issuance here, we see that the amount which shareholders have to inject in equity for a given stock of capital and given stock of assets in place is higher when the value of when the amount raised on the bond market is lower. No? So if you raise less money on the bond market, equity holders have to inject more equity for a given stock of capital. And that's why, in principle, these shareholders, they like to have a high value of debt. So if the firm takes actions which lower this value, this hurts the firm. So the firm fully internalizes the value of newly issued debt. That's great. And if B is 0, so there's a world without long-term debt, it's only short-term debt, then the firm fully internalizes for the bond market the whole value of the firm, right? Debt and equity. But the problem is that if there is existing debt in place, the firm does not internalize the effect of its actions on the value of existing debt, because there's no way for the bond market to internalize this.
P is endogenous or exogenous?
Yes, P is endogenous, and I didn't tell you yet how it's not, and that's this slide exactly. So this is the last piece of the model, is how this bond is priced. This is of course key for the firm because a high bond price means a low spread and so a low cost of capital. So creditors anticipate that whenever epsilon turns out to be too low, there will be default. Whenever epsilon is high enough, there's full repayment. And so with some probability, they get paid back fully. With some probability, they get only the liquidation value of the firm, which is a bit less than the assets in place. And so these creditors, they're just like shareholders in the sense they're risk neutral. They have the same discount factor, and they price these bonds. So they're competitive, so they just break even on expectation. And that's then the bond price which they pay. It's the weighted average of the likelihood that full repayment is realized, or if it's default, then all debt holders have to share the recovery value of this firm. And that's the whole model. Right. And now, in the end, we can simplify this problem a lot. And what I will show you now is just one first order condition. So in the end, you can rewrite this model in terms of only two choice variables. The one will be then basically capital or scale of production, and the other one the epsilon bar, so the threshold value epsilon bar, and this maps to the capital structure decision. So if a firm chooses high leverage, so high ratio of debt financing to equity financing, this will imply a high default risk and therefore a high threshold value epsilon bar. And now we look at the special case here. So for tractability here, I assume that the recovery value in case of default is 0. So here, if default happens, all assets are destroyed. This is an extreme assumption, but it makes these expressions transparent. And I also assume for a moment there's no existing legacy debt. No, this is like a standard short-term model now. and we look at the first order condition for threshold value epsilon bar. This is the marginal benefit of increasing epsilon bar. This benefit is a tax advantage. So whenever default is avoided, this firm has to pay some positive tax. And and whenever you have a higher value epsilon bar, you reduce this tax burden. Okay, this is not super interesting. The key term maybe of the paper is here, the cost of raising epsilon bar. So when I increase epsilon bar, and I raise by the density of epsilon bar, the likelihood that default will happen. Whenever default happens, in this model, the whole value of the firm is destroyed because recovery value is 0. At the default event in this two-period model, the value of asset is exactly equal to the value of debt. So these are the expected costs of default. This is a trade-off how epsilon bar is chosen, the tax benefit of debt versus expected default costs. And I can divide both sides here by capital, and then one can show in this model is that if I play around with Z, so that is this average productivity parameter. If Z is high, then capital stock is high. If Z is low, capital stock is low. But it turns out that leverage will be constant in this model, and this also implies then epsilon bar will be constant. So in this model, without long-term debt, the default rate and the credit spread are constant average productivity Z. So in some sense, they are cyclical. No? If you have a boom or not in this two-period model, doesn't affect leverage and doesn't affect the default rate. So this is our benchmark case where we start from. And because now this changes once we have some long-term debt in place. And it's interesting because, so we write on the same first order condition, the tax benefit is on the left-hand side, and the only thing which changes is the right-hand side, is the marginal increase in expected default costs. And again, because now what happens is that the firm still fully internalizes the whole tax benefit of debt, no matter if it's old debt or new debt, you get the same tax benefit. But the cost of raising leverage, of raising the default rate, is you only internalize that you lower the value of newly issued debt, but you don't internalize the fact that you also lower the value of existing debt issued in the past. No? So you use a firm, you don't care if existing debt loses value. The only people who care are the people who already bought these bonds in the past, but you don't interact with them anymore on the bond market now. So so this means you weight less the expected cost of default. And again, I can divide both sides by capital, and then you see that essentially with long-term debt, I have the same first order condition as in the short-term case, but I add another term. And this term here is simplified in this way. So the marginal benefit of increasing epsilon bar with long-term debt is higher now, so I add a positive term because I have the same tax benefit as before, but I bear less of the cost, so I might as well have more of this tax benefit by increasing leverage. That's great. And so the highest B, the highest the default rate is one result. And very interesting, about this paper, very centrally, this effect that I choose a high default rate is high whenever capital is low, right? So this term which I add on the right-hand side, it's falling in K. So and that's key, no? Because an intuition is very simple, no? So whenever the ratio of existing debt is high relative to the total stock of capital, and therefore also to the total stock of debt, then I disregard a large fraction of total default cost, and so I choose a high default risk. But when B is small relative to K, so the existing stock of debt is small relative to the total scale of production, so total debt, then I disregard, then I internalize most of the default costs, and so I'm very cautious by choosing epsilon bar. And now what happens now if Z moves in this model, then this shows up in the first order condition of 4K. So then for high Z, it's good times, firms invest a lot, then K is high. In this case, I add, this term is relatively low, so default rate is relatively low. And that's how, with existing debt in place here, the default rate becomes counter-cyclical. So default rate is high in bad times, and it's low in good times. Please.
So how does this thing work if now you have this legacy debt, but if you have an additional period where you have, at the time when you choose the long-term debt, then these guys are going to internalize a lot of...
Exactly. That's exactly the point of, maybe the next slide probably, So that's the dynamic model. This is a two-period model, and there's something important missing in the two-period model. Exactly. That's also what Tim said before, And that's it. So but this just gives you some intuition how this feedback loop could arise, right? Because the firm there's a bad shock, so capital goes down. This means the interest rate, the default rate will go up. The firm chooses high leverage, high default risk. Now we take this high credit spread and put it back into the capital for dollar condition. There it means the firm wants to invest even less, which means that K will go down by even more, then this term increases even more, and so forth the spread will go up by even more, and that's how these things amplify each other, right? And and now exactly there are maybe two questions which are important, which are missing. So one is of course that B here is just a parameter, but the dynamic model is endogenous. It's chosen by firms in the past, and it's interesting. And also second, then we try to get a bit of an idea how big can this amplification mechanism will be, and that's also why dynamic model, which is solved numerically, then is a nice model to study, to get some ideas about the size of this effect. And the dynamic model is very close to this two-period setup. So it's as close as possible. So we add just very minor elements. This thing, you know from the two-period model, so we allow firms to use short-term debt as before. So there's a claim the firm can sell a promise to pay 1 year of debt next period, and there's a price for that. That's short-term debt. That's the standard device which you all know from other models. And there's a different debt contract which you also offer to the firm. So the firm can also sell long-term debt. And this long-term debt is a promise to an infinite payment stream with a geometric decay. So if a firm sells long-term debt in period T, this firm promises to repay a fraction gamma of this debt next period together with a coupon payment. Then in period T plus 2, 1 minus gamma of his debt is still outstanding, and again on this remaining fraction, the firm again repays a fraction gamma plus C, and so forth. So over time, there's a geometric decay in this payment, and yeah, this bond goes back to Leland in the 90s, and that's a nice way to model long-term debt because it allows us to summarize the whole history of past long-term debt issuance of a firm with a single state variable. Okay. These are the two instruments which the firm can use. And to make this maturity choice a bit interesting, so we introduce the last new element, which is an issuance cost on the bond market. So whenever this firm goes to the bond market and sells new debt, it pays an issuance cost. So in practice, the investment banks, and they do these things for you, and you have to pay them a fee. And in practice, it's about 1% of the revenue on average in the US, of the revenue on the bond market raised. And this means, this issuance cost is important because it means that this firm, in principle, this makes long-term debt attractive. Because if you have long-term debt, to have the same leverage over time, if you have short-term debt only, all of your debt matures each period, and so you have each period you have to sell an enormous amount of debt, of bonds, and you pay lots of issuance costs. But if you have long-term debt, only some fraction of this debt matures each period, so only you have to roll over some fraction of this debt, and so you save on this issuance cost. So this is something like a very simple but empirically relevant benefit of long-term debt. And that's all what we add to the two-period setup. And apart from this, of course, we have many periods now. And now the creditors, they price the short-term bonds and the long-term bonds in the same way. In both cases, they want to break even on expectation. And and this is how we solve the model. So now, what's important? So this firm, as before, it maximizes the shareholder value, subject to creditors break-even conditions. So now there are two. These creditors need to break even expectation both on short-term debt and long-term debt. And we assume that this firm cannot commit to future actions. Because this might matter in this model. Maybe I'll talk later about this. So the firm takes its future policy as given and then chooses its firm policy today as the best response to what the firm will do in the future. And so we look at the macroeconomic equilibrium of this game which this firm plays against its future selves. So all strategies of the firm are functions of the current state of the firm. And we also have to choose some parameter values. So this is partial equilibrium. It's just a firm problem. So which the riskless rate and the wage rate, they're set by us. They're parameters here. And then we put some discipline on these values here. For instance, the repayment rate. So how fast does long-term debt this payment decay? So literature calculates the average duration of these bonds. This is what we use to discipline how fast this long-term debt gets paid back. And we also try to match the factor shares because this matters because this firm only uses firm financing to finance capital, not labor. No? So this limits a bit the relevance of this friction potentially. And importantly also we target the leverage and long-term debt share of US corporate firms, non-financial firms in the US. And this is important because these are also the average spread. And these three variables, they're very important for the quantitative size of our effect. It's the default rate. So here, at the moment that the shock hits the economy, even with short-term debt, there's a tiny increase in default rate, but it's very, very, very tiny. In our long-term debt model, there's a relatively strong increase in default rate. And this means also spreads will increase at this point, and this makes the cost of capital go up. And this is exactly the mechanism which I showed in the two-period model before. And the default rate is long for some time until it goes down again. It becomes even clearer if I show you a productivity shock which does not go back to the mean but stays low. So they are forced the productivity shock to stay low. And there I see that the default rate remains high for about 10 periods. This is exactly as long as simplification is present. And this is exactly as long as this ratio of old debt to capital needs to go back to its now lower stable level. And this is now, so now we have two things. We have amplification, and we now understand a bit why, no? But we also have this persistent amplification. And this is in principle interesting because nothing in the model exogenously which induces this persistence. So it's really the ratio of how slowly this existing debt converges back to its lower level. And this, of course, then is driven by the firm's maturity choice. And that's now where your question goes to. And so let's zoom a bit into this persistence phenomenon here. So first of all, this is a policy function. Oh, please.
Just a clarification. What are you holding constant across the three things? Are you holding the parameters the same? Are you holding the leverage the same?
Yeah, actually, for the dynamics of the frictionless model and the short-term debt model, they're always the same. So that's why I actually cannot tell you because it doesn't matter.
Sure, but
yeah.
between the STD and LTD?
Between the STD?
Are you having the same leverage ratio? Are you
no, so actually it's true that actually between the red line and the blue line, the average leverage is different, the default is different. Actually, we hold most of them constant, but it's really true that it basically does not matter. So the short-term debt model, no matter what you do, it will always look almost like a frictionless model. No, it doesn't really add any dynamics. So it's really only interesting thing happens once we have long-term debt in this model. And so let's zoom in a bit. So that's the policy function of the default rate. So this is a bit, you think on the x-axis here you have the firm's state variable. And as we know from this two-period model, if the ratio of existing debt or if existing debt is high, then this firm internalizes a smaller fraction of total default cost, and so chooses a higher default rate. And so it's always increasing the default rate in this space. But it matters also, as we said, we know it's counter-cyclical. As in two-period model, when let's say I'm in this point and then a bad shock happens, so now I go get a low productivity shock, so the firm invests less. This now means the firm lowers long-term debt and lowers the amount of total debt. This raises the ratio of existing debt to total debt, so the firm now chooses a high default risk, so it jumps up. But then what happens afterwards depends on how the firm in the future will choose long-term debt. Now, if the firm today increases leverage through short-term debt, then tomorrow I will wake up with very little long-term debt. But if I do the same thing with lots of long-term debt, I end up here. And you see that it matters for the default rate. So to understand the dynamics of the default rate, we have to look at the firm's maturity choice. And so here we see how the firm chooses the stock of long-term debt. As I said, so a given amount of total debt, you can finance, if you want, only with short-term debt, only with long-term debt, or any combination. And this is how the firm chooses the stock of long-term debt. Initially, when the firm wakes up with little long-term debt, it chooses a smaller amount of long-term debt. But the higher existing debt in the past, the more long-term debt I choose in the future, or I choose today. And so these firms, if a new firm is born, it will move up in this space over time until it reaches a very high point here. So these are stable points here. And so why is that? This is an interesting phenomenon because it means that these firms in the beginning, they look very prudent, so they are aware of bad consequences in the future, but these firms in the end here, they are completely careless and accept. No, but this is fine. So there we are always, so there's never, this does not cause any issues. There's always positive issuance. And so this is, if the issuance cost would be too high, then this could create, problems because some firms would adjust and some firms would not adjust. But this is not happening because this issuance cost is not high enough for that. So I just see that there's always positive issuance of both debt contracts.
So you do solve a model where with a positive probability you stay at zero, you don't issue any new long debt?
So we solve a model where we don't allow to use long-term debt. But it's, so now I understand the question.
So the true solution, how do you solve the model? Because the true solution has a discontinuity.
In the point whether you issue any long-term debt or zero, or at which point?
No, a king in the policy function for a range of states, you don't issue.
So it's,
Then what you start issuing.
so I guess what you say is true for some parameter values. So you mean this is true if this is what the issuance costs, right?
It could be that for some parameter values is infrequent, but I would say it can happen for any parameter value. in principle.
It's about this eta, right? So you, or what is this king rates is eta or
It
to
is
something
king,
different?
right?
What do you mean?
Because of the absolute value. I mean,
Okay, so this I could take away, it would be the same problem.
What?
So we also at some point we took it away and we had the same equilibrium. So that's fine. So maybe
Talk about it.
exactly.
There are easy ways to fix it.
Yeah, but this is it's not supposed to be interesting. This
No, I know. But you also want it to be.
I mean, because this is the answer to what my question.
no, it's
But now
not.
you're saying it's not important, so that's.
No, so no, it's
No.
No,
so
you have this cost of adjusting the long-term debt.
no, it's true. So
The exact shape is not important, I think. No.
I see.
but so
But
it's
yeah, the costs are crucial. Otherwise, you wouldn't issue a long
yeah, this needs to be positive. But other than that, nothing here is important I want to claim. But let's talk about later. Yeah.
No, but Joachim, this was what I was asking. It seemed to me that it was better for the firm
Yeah.
to always have short-term debt.
Exactly.
And I wanted to see why you have long-term debt.
Exactly, and that's the
because
next-
you put a cost of adjustment into.
Yeah, but that's not.
debt.
But that's part of the story. But you see, the interesting thing is that this firm here only issues long-term debt because of this cost of adjustment. Because that's the only reason why the firm likes long-term debt.
Right.
But this firm is different. It chooses much more long-term debt. It could choose the same value, but it chooses the higher value. And that's the interesting thing about the model. So what's this maturity choice? What's going on here? So the problem is issuing long-term debt is that the firm knows in the future there will be a high default rate. And also the creditors knows this. So creditors for a firm with a high long-term debt, for long-term debt, they already paid today a lower bond price because they know in the future the default rates will be high. And so now why does this firm, once you move to the right, once there's more existing debt, why does this firm choose to have more long-term debt? And the reason is that not all costs of this higher future default risk are actually borne by the firm today. Because high default risk in the future also hurts the people who already have bought your bonds in the past, long-term bonds in the past. And the higher it be, the higher is the share of the cost which is borne by these guys. And that's why the firm, for the same reason why there is this whole action in default risk in the first place, chooses to have also more long-term debt, the higher stock of existing debt. Okay? And in the end, it's there's a commitment problem here. So because in the end, of course, yeah, maybe I don't know how much time I have, so probably I should not. Yeah.
So you have 10 minutes.
Okay. So but this is important. So now we understand. So a firm here internalizes all of the future default costs, all the future costs of long-term debt, because there's no existing debt in place. But once next period, this firm starts from here and chooses again, and chooses a higher value of long-term debt because this firm bears a smaller share of total cost of long-term debt. And that's how these firms end up in a high place. But we wanted to see how this thing matters over the business cycle, and this now is crucial for the persistence of this amplification effect. So we zoom in here now in this point, and let's think about a firm. There was always a medium productivity state, and now suddenly there's a bad shock, and now these firms choose a different value of long-term debt. They choose less long-term debt, but the new stable value is much lower. But the firms will converge there only slowly over time because of this reason. Because these firms going the fastest as possible, and it would also increase the firm value, total firm value, and increase firm output. But it would also constitute a transfer from these shareholders to the holder of existing debt. Because, an example, for instance, this firm, they can always keep leverage constant if they want to, and sell lots of short-term debt to buy back long-term debt. There's always one thing which you can do. But once you do this, if leverage is constant, the price of short-term debt is constant when you do this. So it will not change during this operation, but the price of long-term debt will increase because future default risk will reduce in this operation. And so the price moves against the firm, and so the shareholders, they will lose money in this operation. Existing creditors are happy because their long-term debt increases in value, but the firm does not internalize this. And that's why this firm will move only very slowly here, only because old long-term debt gets matured. Only in this way the firm goes down to a lower level. And this is how long it takes then for this amplification effect to die out. Because as long as this is the case, the default rate is above its long-run mean level. Okay. And that's the answer to this question. No? So this, and this phenomenon that long-term debt is sticky in this sense, so it moves very slowly. This is completely endogenously. Is also identified by other papers. For instance, this is about a paper about sovereign long-term debt. It's a corporate finance paper. And of course, here it's crucial in our amplification mechanism. So it gives us the persistence. No? Amplification.
What do they mean by sticky?
So it means that if long-term debt, so that it moves slowly over time, right? There's nothing exogenously, there's no adjustment cost or anything. Nobody forces this firm to move only slowly in this space. No? In principle, the firm, if it wanted to, it could just, if a bad shock happens, directly jump to the lower level, where it will end up eventually anyway. In this sense, it's sticky. No?
This is what always happens, no? That optimal not to run down with that.
But here, it's actually, so if you define firm value as the sum of all debt and all equity claims, then what the firm does here is not optimizing firm value, because by going slowly there, I reduce this firm value, but I avoid to make this transfer from shareholders to existing creditors. That's the interesting thing here. Yeah. Okay, and then we can play a bit around with this model. So one thing, this amplification effect is very nonlinear, or is nonlinear. So if we have, this was a negative productivity shock, we said, okay, this amplification was 150%. If we have a positive shock of the same size, we get less amplification. So negative shocks are more severe. And then again, it's about the ratio of B over K. So that's a nonlinear function of K. And so negative shocks drive up this ratio more, then positive shocks reduce it. A bigger negative shock.
You're measuring at time zero. So what is?
Yeah, this is always time zero, exactly. Yeah, it's not now here. Don't quantify persistence. Yeah, I could also do that. Yeah.
So I think when people talk about amplification, if you look at the response of output to something, it jumps and then it keeps going up for a while, and then at some point it goes down.
This is something nice to have because that's. But
that's not what you're talking about.
in this model, there's no way to get this. So then also, if we have a stronger negative shock, amplification is stronger than for this moderate negative shock. So it's also nonlinearity here. And here we do two different things. So here we solve the same model, but with more persistence in the productivity shock. And that's interesting because here there's less fundamental volatility because you're more stable. But this means firms in a good state, they are more valuable. No, they know that they will be longer in this good state, so they will also take on more debt. And in a low state, they will take on less debt. And then, if I have a negative shock, because existing debt, B will be higher relative to K, then the multiplication effect is stronger then. So if firms build up more debt in good times, the recession afterwards is more severe. That's something which we get here. And that's the opposite. No? So one thing which we also can do, we can just assume that this long-term debt is less long-term. No? It's shorter maturity, so it's a higher repayment rate. Then these firms also end up with having less long-term debt. And then if a bad shock happens, then the multiplication is smaller, no? Because then B over K, B is smaller. So this is really an important state variable here. The amount which firms, or long-term debt which firms accumulate in the boom determines how bad the recession is afterwards.
What does the model predict for the cyclicality of the average maturity?
Yeah, so here actually, so here we get pro-cyclical maturity, and I guess, but this is really quantitative results, so it's not obvious. It's not always the case that we get that, and we don't use it a lot, this result, because in the data it's not super obvious if it's really strongly cyclical. So it looks a bit more pro-cyclical.
Issuance, I guess, in bad times we issue only short-term debt.
It's true. So it looks a bit pro-cyclical, but actually,
Stock of long-term debt that takes a while. I guess
Yeah.
you have these two forces that go in different directions.
exactly. So in the data, exactly. So it's, if anything, it looks pro-cyclical in the data, but we get really clearly pro-cyclical, and also our maturity choice is very simple. No, I think so. What we need in our model is not really. So we just have short-term debt in here because it's a standard thing to have. It's not obvious that firms have access to this super short-term debt which you can repay before you take a new decision. So we could have the same model only with this long-term debt claim and would have the same dynamics. And
and this was a question I was going to ask. No, I didn't want to ask it at the beginning. You're not allowing the firm to lend, right? Because this is a
No,
whole thing in finance, although, what's his name? Who's that guy at MIT wrote his thesis on this? Angelitos.
Angelitos, yeah.
Yeah. He I mean, but this is much, he just didn't know about it. People in finance had noticed this a long time ago. Because the debt, one of the debts has its price changing, you can get insurance against shocks by going long in one and short in the other. And you're not allowing the firms to do that.
No, our firms don't want to do that because our firms don't want to do that. That's the thing. Because
you don't want to insure
first of all,
themselves?
they're not risk averse. First of all, that's maybe that's
No. That's almost an answer. Yeah.
Yeah.
So they don't want insurance.
Yeah.
Fine. That's fine. They just want the cheapest way to finance it.
exactly. But it's I mean it's a good point. No, so to have like a real nice maturity choice model, I think we would like to make our firms risk averse. No, this would be one thing. Long-term debt is about this also. We don't have this here, so we don't really.
But with transaction costs.
Yeah. That's probably. Okay. But we want
okay.
to finish up.
In 2 minutes, right? Or
I stole a minute, like 1 minute.
okay, but I think it's okay. That's fine. Exactly. So here there are more variables. One thing which we also like, a little bit at least, is that we have a term structure of credit spreads here, also spreads, and the short-term debts, of course, these spreads they are much more responsive to whatever happens after a shock than long-term spreads. So we can get this pro-cyclical term structure, and that's something also which we observe in the data for credit spreads. And and as I said, long-term debt share. So this is the stock of long-term debt over total debt. That's this is very pro-cyclical in our model. Yeah, but we don't want to. It's not meant to be a maturity choice model. So the key message here is that once you have long-term debt in the model, you get these amplifications to countercyclical credit spreads. That's our main point. And and this is the last slide. And here you can see how it's really still work in progress. So one thing which maybe it's the bad thing. So even though on impact, if output goes down, this ratio B over K shoots up. This is the key for amplification mechanism. Since afterwards, it is on a lower level when also output is below trend, in the end it's procyclically correlated with output, and the same for leverage. While the data is negatively correlated, but it's probably because we have too little fluctuation in output, and so we have too little shocks, and that's why this impact thing does not matter so much in these statistics here. That's something to work on. And that's also important. This is maybe another point here. Default and spreads, these are very key for mitigation mechanism. We get them to move much more than other models, but it's still in order of magnitude too low compared to the data. When the data, these default rates and these spreads, they move around much more. So there's still room. No, that's not the last paper to write on this topic. And that's it. So yeah, what we did, so we just introduced long-term debt to a pretty standard model of financing investment, and this gets this new interesting financial amplification mechanism, which is this adverse feedback loop between investment and high credit spreads. And maybe even more interestingly, or as interestingly, this effect is persistent because of firms' endogenous choice of long-term debt. And we find that this is a sizable and asymmetric amplification effect, and maybe something which could lead to a policy implication at some point is that we find these recessions are more severe if in good times firms accumulate more debt. And that's something maybe then which policymakers can worry about. And that's that. So.
Very good. So if you want to speak to the RBC literature, I think one thing that is maybe, so your capital moves a lot.
Yeah, this is partial equilibrium here. So one thing what you want to do is, we have a firm distribution here, and so it's not super easy to make a general equilibrium framework out of that, but we could make some quick and dirty tricks to destroy this distribution and still have the same model, sort of. And then we could have a GE model, and then we can worry a bit more about these things, no? Because that's why capital moves so much here, because there's...
As much as output.
Yeah, but this is why, because it's partial equilibrium, I think.